Welcome everyone and good morning. On our webinar today, we're going to cover areas of tax risk that apply to exempt organizations. So my name is Christine Perez, as Amy mentioned. I'm a manager with the Eide Bailey Exempt Organizations Group. I work in the firm's National Tax Office, or NTO, with Kim Henwardson. My contact information is provided on the screen, so if anyone has any follow-up questions or if anyone would like to reach out after today's presentation, you may do so. So just a quick agenda and overview of today's topics. We have 7 primary areas of tax risk that we will focus on. The first 6 areas listed are all commonly identified as top tax risk areas for 501c3 organizations by the IRS and are mentioned in recent TTE program letters and the Treasury's priority guidance plan. We've added a 7th section down at the bottom to kind of cover other top areas that organizations should review and be aware of as well. So I'll note that our presentation today is focused on tax risk as it applies to 501c3 organizations, but those watching that are associated with other tax-exempt organization types will find the discussions also applicable to their organizations as well. So with that said, let's get started on the areas of tax risk. And our first slide here gives kind of a good outline by referencing the definition of a 501c3 organization. But to be tax exempt under IRC section 501c3, an organization must be organized and operated exclusively for exempt purposes as set forth in IRC section 501c3, and the organization must not be organized or operated for the private benefit or interests of individuals, and none of its earnings may inure to a private shareholder or individual. Lastly, there are restrictions on how much political and legislative activities an organization may conduct that is exempt under 501c3. And then, a 501c3 organization that fails to meet any portion of this definition does risk its tax exempt status. So let's see, this next slide covers 2 of the qualifications under 501c3. Now, 501c3 organizations must follow specific regulations that require that they're both organized and operated exclusively for an exempt as set forth by 501c3. Organizations that meet both of these organizational and operational tests are eligible to receive their tax-deductible contributions under Section 170. If either of these tests is failed, the organization would expose its exempt status to loss. So when we talk about the organizational test that needs to be met, the organizing documents limit the organization's purpose to those that are listed in 501c3 specifically, and an organization cannot empower or engage other than an insubstantial part of its activities in any activities that are not of its exempt purpose. So in addition to that, the assets must be permanently dedicated to the exempt purpose. And so this means that in the event that an organization dissolves, all of its assets must be distributed for that exempt purpose. And that's the dissolution clause. Now, under the operational test, an organization will be regarded as operated exclusively for exempt purpose if it engages in activities that accomplish the tax exempt purpose under 501c3, activities that are more than insubstantial and do not further the exempt purpose will cause an organization to fail this test. So the next area is private benefit and inurement transactions. And these are an area that really can result in hefty fines and penalties for tax-exempt organizations and also the individuals that are associated. And it's an area where failure to comply with these provisions can directly result in the loss of an organization's tax-exempt status. So we'll start with private benefit. Now, the concept of private benefit is, it's broader than private inurement, But the idea here is that the activities of the organization really should further the exempt purpose under IRC 501c3 and should not benefit the private interests of any individuals or other organizations in a manner that is more than insubstantial. So organizations really should focus here on the transactions that are performed with other parties and just ensure that they are done at fair market value. With private inurement, the income and assets of an exempt organization should not benefit insiders of the organization. And when we talk about insiders, we're including people such as officers, board members, directors, trustees, as well as employees of the organization. I think one of the focus areas here really is on compensation and automatic access benefits, where we have an item that should have been picked up as compensation, say on the W-2 for an employee, but it wasn't necessarily treated that way. And failure to comply, with private inurement sanctions here may result in the revocation of exemption. And here's our first polling question. Wonderful. Okay, and answer C is correct. 501c3 organizations really must serve public interest. So following our discussion on private benefit and private inurement, we have intermediate sanctions, and these are really designed to curb potential abuses by penalizing the participating parties, that both those that benefit and those that knowingly authorize, and they will apply if there's an excess benefit transaction with a disqualified person. We've got the definitions of excess benefit and disqualified persons below. So here's a quick look at the potential penalty tiers, and you can see that depending on the size of the transaction, the penalties on the disqualified persons can be quite severe. So those first tier penalties, 25% of the excess benefit received, and the second tier at 200% of the excess benefit received. In addition to the penalties on the transaction participant, penalties can also be assessed on an organization's management team, and those individuals who knowingly enter into the transaction. And those caps are set at $20,000 total for all managers. And you'll note there that it must be willful and not due to reasonable cause. And lastly here, with respect to these transactions, we've got the rebuttable presumption of reasonableness. And really what this means is that the burden of proof is shifted onto the IRS to prove that the transaction was not reasonable. So our next risk area about includes political campaign activities as well as lobbying. And now, as a reminder, these are two completely separate areas, and they're subject to two different sets of rules with different consequences of exceeding the limitations for each. So even though a lot of times we see them kind of lumped together as one activity, we want to discuss them as separate activities today. So political campaign activities are essentially a big no-no for 501c3 organizations, and the participation, whether it's direct or indirect, is strictly prohibited. Political campaign activities that are done on behalf of or in opposition to any candidate for public office are in direct violation of the prohibitions in the Internal Revenue Code sections, and they may result in the revocation of the exempt status, as well as excise taxes or penalties that are assessed on the organization. So tax-exempt organizations really should review these activities and any expenditures for kind of facts and circumstances to ensure that if they are conducted, that their activities are conducted in a nonpartisan manner that does not constitute a prohibited activity. So when we talk about lobbying, on the other hand, with respect to a 501c3 organization, we're referring to activities that attempt to influence legislation. And in general, 501c3 organization can engage in some lobbying, but the lobbying activities that exceed the substantial part and expenditure tests can jeopardize an organization's tax-exempt status. So with respect to lobbying activities, typically the type of the exempt organization, the type of activity, and also the scope of the activity are all going to play a role in determining what the potential consequences are. So when we look at lobbying, what might be okay for one organization, say we're looking at a private foundation, that same activity may exceed the acceptable limitations for another organization and result in penalties. So it really is kind of a case-by-case basis for each organization. And it's recommended that organizations track and routinely review all of their lobbying activities and expenditures to assess those potential restrictions and also their tax risk and exposure on an annual basis. So our next tax risk area that we'll talk a little bit about are federal reporting obligations. Now, in general, most tax-exempt organizations are required to file an annual information return with the IRS. Most organizations will file the forms via Form 990, Form 990EZ, or Form 990PF. Smaller organizations with annual gross receipts of $50,000 or less may be eligible to electronically submit that Form 990N e-postcard. And other specifically exempted organizations may be accepted from filing altogether, but I would note that this is a pretty limited list. So in general, when we look at an exempt, we want to see some sort of annual filing requirement being done for them using one of the 990 series returns. So, kind of down at the bottom here, we've got a little note, but failure to file an annual federal information return for 3 years is going to subject the organization to automatic revocation with the IRS under IRC section 6033 and that's subsection J. So now the IRS is going to be sending out kind of additional letters because under the Taxpayer First Act is formally required to provide the notice to organizations after 2 years of non-compliance. The IRS does typically already send notices out, when you miss your filing or go past the deadline, but these letters are all going to be updated with the specific code requirements that relate back to the Taxpayer First Act in this requirement. So we're hopeful that organizations will receive these and we won't have the issues that come up with failure to file 3 years. Because it is a very real tax risk, and it's typically one of, I think, the most common causes that I usually see for revocation of taxes exempt status. And oftentimes it's too bad when it's a case of, filing that Form 990 and e-postcard and something happens within the organization and there's a change in the management group or a change in the volunteers, and a small organization that had this minimum filing requirement to go online and submit the e-postcard, well, it doesn't get done for a couple of years and nobody catches any of the letters the IRS has sent out. It unfortunately results in automatic revocation after 3 years, and where it would have been very easy for a smaller organization to keep up that 990N e-postcard filing, they're now saddled with, going through all the hoops that come through going in and applying for retroactive reinstatement and completing the forms to resubmit and reapply for tax-exempt status. And kind of on that note, even if an organization was not originally required to apply for tax-exempt status, when they lose it due to the automatic revocation, they are required to formally go in and apply for the reinstatement. So If it were working with a C3, you would be required to go back in and fill out the full 1023 forms and pay all the fees associated with that filing. So here we go, polling question number 2, and it asks, most tax-exempt organizations have an annual federal reporting obligation, true or false? So most people have it right, or at least mark the correct box. The answer is true. Most tax-exempt organizations have some sort of annual federal filing reporting obligation. All right, so now our next area of tax risk that we'll cover is UBI, or unrelated business income. So UBI really is one of those items that I think most people or most organizations have heard of. But I think that it is kind of a commonly overlooked area for 501c3 reporting, or at least it's an area kind of denial for many organizations. And I know in my experience as a preparer, a lot of times we'll kind of get a one-word response or answer when we ask sometimes about unrelated business income. And it's one of those areas that we really like to stress that the recommendation here is that organizations routinely review their activities for sources of UBI in order to maintain compliance with the reporting rules. And if there is an activity or if there is a question, that it is brought up on that annual basis, and whether it's time to file the 990 and the question is asked, or it's brought up with the audit team when the audit team is out there. It's always good just to cover these rules, make sure that there's not something that's subject to UBI, and a lot of times it's just a case of, if it is an activity that's not subject to UBI, also making sure that you have the documentation or analysis to support that it's not an item that would be subject to unrelated business income. So to define unrelated business income, it's income that's created by the activities of an organization that are regularly carried on for profit and that are not substantially related to kind of the overall exempt purpose. So this category really does have quite a few exceptions and nuances and rules. And so it does really require that review and annual due diligence by an organization to make sure that it's compliant with respect to UBI and 990T reporting. So once we've kind of identified the areas of revenue as UBI, it's helpful to know that an organization can go ahead and can allocate ordinary and necessary business expenses against that UBI revenue. So, if you're working and you've got $10,000 of revenue that's been allocated or assigned as UBI, any expenses associated with creating that revenue, we'd be able to go ahead and offset against that income. And for many organizations, that's a way for us to try to get that down as much as possible, because of course at the end of the day, any net income associated with the unrelated business income is going to be taxed at the regular corporate or trust rates and reported on Form 990T. So kind of most recently for this last year, we're looking at a 21% tax rate on unrelated business income per those changes through the tax. So let's see, I'll note that there is really not a bright line test for UBI, and kind of the rules really are that, tax can be jeopardized if the unrelated business activities become substantial or really become a large part of the organization's operations. Now we've got a note down here at the bottom, but the Tax Cuts and Jobs Act most recently required siloing of unrelated trade or business activities and also taxation of qualified fringe benefits on the Form 990T. Now the siloing rules fall under IRC 512A6, and they indicate that you can't use losses from one activity to offset income from another. And the IRS released some guidance last year, and that was on Notice 2018-67, But I think most people will agree, there are still a lot of questions out there surrounding the siloing rules. I had an opportunity the other day to listen in on the exempt organizations update discussion, and that was presented by the TEGE Exempt Organizations Council. And really the current advice that they're giving people is that, you know, additional regulations and guidance are coming. They're in the works, and we're hoping to see that soon. But for now, organizations should be using a reasonable method to apply the 512, A6, and A7 code sections for siloing and also for those qualified fringe benefits. So really, as long as your organization is using a reasonable method, and kind of referring back to that notice 2018-67, you should be pretty good and pretty safe on what most organizations are doing or how they're siloing on the Form 990T. Now, IRC section 512A7, which increases the unrelated business income by disallowed fringes. This goes back to a couple other code sections that we would see apply to for-profit entities. So section 274 that disallows deductions, and section 132F that defines a qualified transportation fringe. And I think many of us have seen the qualified fringe benefits come up as an issue, and it really is an issue for the organizations that are operating in larger cities that are paying in some form for their employees to park. And I think a lot of people are hopeful that eventually this may be repealed, but unfortunately there just has not been much movement on this issue. And I know the folks in Congress right now are a little bit distracted by other matters, so this just hasn't come to the forefront. And again, when I refer back to kind of the guidance that's been given by the TEGE Exempt Organizations Council, really the guidance is indicating that they're going to be issuing additional guidance on and regulations on this soon. But again, it's going back to that reasonable method of reporting. So here are a few of those exclusions and special rules that I mentioned kind of when we're going through the previous slide. And some general exclusions from UBI are interest and dividends, capital gains, royalties, and real property rentals. However, note that debt financing that is on the real property can make that rental income taxable. Now, there are special rules for interest, rent, royalties from controlled entities where that income that would normally be excluded as a general exclusion would be picked up in UBI. And these all fall under Code Section 512. And then lastly, we've got some other exceptions. And I think these are where a lot of organizations typically kind of fall into the first category, where an item of income is either falls under the general exclusions, or we meet one of these other exceptions. And these really allow you to exclude something from income from being treated as UBI when we've got a convenience of members exception, members, students, patients, or employees. We've got volunteer workers, or we've got donated goods. So a lot of times, you know, when I think of these other exceptions, my thought goes straight to kind of the gift shops or the ancillary activities that are really kind of set up, you know, maybe in a hospital environment. And, you know, as soon as we have some of these convenience like the patients or the members, or if we've got a gift shop that's 100% run by volunteers, you know, something that could be UBI, if we were to look under just the regular rules, can be an exception or an exclusion for an organization. But again, this is something that if you do have an activity that would typically fall under the UBI rules, it's good to document the case when it falls under an exclusion or an other exception to one of the rules. So this slide provides a bit more detail on the special rules pertaining to income from controlled organizations. And with control, that's direct or indirect, the interest, royalties, and rents that are passed through, they may be treated as UBI if they're almost treated essentially as an expense by the other organization within the controlled group. And this falls under some of the related party rules of IRC section 318. But I think this kind of provides that little exception to the rule where, you know, generally the interest, royalties, and rents are excluded, but all of a sudden we need to have our entities watching with any for-profit or even exempt subsidiaries that in an issue of control, we could have some of those typically excluded items actually be subject to UBI reporting and a 990T filing for the year. So this slide lists a few common examples of unrelated business income. And we've got advertising, pharmacy sales, management services, debt, finance, rental income, laboratory services, catering, commercial testing, and also alternative investments. And, you know, with some of these, you could potentially find an exclusion from EBI, but typically these will fall into the unrelated business income category. Advertising is just one area I'd like to quickly focus on because I think this comes up a lot. And it, in general, when we see advertising, it's going to be taxable. That's kind of the default. And when we look at advertising, we're really defining that as an advertisement that has language, which is an inducement to purchase a product or service. It's providing price information to the viewer. It's indicating savings. It's an endorsement or a call to action as well. And they also provide that contingent pricing information. And I think a lot of times it's really a question of whether something falls into the advertising category or into the sponsorship category. And so that's just one area to highlight, I think, when people are looking or organizations are looking at the revenue section is when you receive that payment for someone to be listed in your newsletter or kind of an annual or monthly or quarterly subscription or newsletter is, you know, is that advertising, which is the default. And then when we're talking about, you know, sponsorships as related to, say, a golf tournament or something different where we've maybe just got a little sign or we mention our sponsors and show a quick little logo. So two different items there, and it's always good to kind of question whether something is falling under that advertising unrelated business income or whether something is a sponsorship. All right, so we're already at polling question number 3. So Amy, I will let you pull that up.
All right. Polling question number 3 is now open.
Wonderful. So the correct answer is A. Typically, interest and dividends are going to be excluded from UBI unless there is a specific item such as dealing with, like, say, a controlled entity or something of that nature that would cause it to fall into the unrelated business income category. So other tax risks. So other tax risks. Now, this is our final section, and we'll cover a variety of other tax risk areas that exempt organizations should be aware of. And this is a little bit of kind of a grab bag, almost, of things that, you know, some organizations may see and some other organizations may not. Kind of the first part of our presentation was really focused towards what 501c3 organizations a lot we'll see, and then this kind of covers a little bit more of these obscure items. So First up is kind of a quick highlight on just foreign reporting, and exempt organizations really should understand their foreign filing requirements and reporting obligations. And the reason for that is because, you know, the penalties can be pretty hefty. So organizations that may fail to file can be $10,000 to $100,000 depending on the foreign reporting form. And global operations and alternative offshore investments, as well as payments that are given to other entities or to foreign individuals, such as compensation or grants that are given to foreign organizations, they're all potentially going to trigger some sort of foreign reporting requirement. And so we just want to make everybody aware that, you know, this is an area that can generate some penalties, and it's a good area to kind of review on an annual basis to make sure that all of those forms are being completed annually. So excise tax on executive compensation, this falls under IRC section 4960. And this is really one of those issues that's going to affect probably a smaller number of taxpayers, and many organizations hopefully and most likely will not encounter this issue. But what it is it's really a 21% excise tax that's on remuneration in excess of $1 million paid to a covered employee, and it also covers excess parachute payments paid to covered employees. So the guidance that was issued in Notice 2019-09, it requires a good faith, reasonable interpretation. But, you know, per comments made by the TEGE Exempt Orgs Council, they're hoping that new guidance will be issued soon. And it's hard to say what soon means. Does it mean, you know, during 2020? Will it take longer than that for this guidance that kind of supplements the Notice 2019-09 to be issued? We're not really sure, but it's really just falling back on that reasonable interpretation is acceptable for how organizations are calculating this excise tax. And any new guidance that they do issue, it's going to be prospective. So if new guidance is issued in the next year or two, you know, I won't put any limits on the IRS there. It'll be prospective. And so what an organization does now to calculate this in a reasonable manner, when the new guidance is issued, if it's contrary, it'll be prospective and it won't fall backwards. So payroll taxes, these really have been a focus area in the 2019 compliance programs. This is an area that is actually highlighted in the fiscal year 2020 TEGE program letter that was issued by the Tax-Exempt and Government Entities Division. And it's really going to be an area that they're probably going to continue to focus on. They have increased focus, and they've got additional auditors that they've brought into this area. So we're expecting that organizations may see some increased examinations just based on this. And when we talk about payroll taxes, you know, one of the main focuses in the fiscal year TEGE program letter was really how does the IRS pull everything in from a data analysis standpoint. So really what they're doing is they're pulling in the data from organizations and they're cross-checking it. So W-2s, they're cross-checking 1099s. And it's really an area where they're trying to pull in that data, and then that will trigger whether or not there's a question on the reporting of an organization. And so really kind of one item or issue that has moved to the forefront is that organizations should be making sure that they have processes in place in order to determine kind of that independent contractor versus employee definition. And so whether or not someone should be pulled in and receive a W-2 for the year, or whether the issuance of a 1099 to an independent contractor is actually correct. So continuing on with a little discussion about payroll taxes, shared employees are a consideration as well. And that's when 2 or more employers are responsible for the compliance items. So typically we would see this when we've got multiple exempt organizations sharing those employees, such as between, say, a C3 organization and a C4. And one of the organizations essentially takes on that common paymaster arrangement. Now, the rules in this area for payroll tax are pretty complex, and organizations really are going to have to focus on, are they reporting correctly, and reaching out to kind of those payroll service providers to make sure that the reporting is correct during the year. And a lot of the payroll responsibility for those W-2s, the FICA, and the SUDA, making sure that that is reported correctly across multiple organizations, if that is the case. So going in a little bit of a different direction, another risk area is sales and use tax. And nonprofit organizations typically make these purchases of the tangible personal property, but they can be free of sales and use tax if the organization is approved by the specific state or an applicable local agency. And typically, they need to meet that charitable organization under state law, and it's not necessarily under federal law. And there's kind of a notation here that a lot of entities do not qualify for the exemption. So just because an organization is a 501c3 does not mean that it is automatically granted this exemption from sales and use tax at the state level. So it's important to note overall that these exemptions, they do exist, but many states and municipalities don't always follow the federal exemption and rules, and they specifically identify organizations that must apply in order to have this kind of nice benefit. So with respect, again, kind of following along with that state and local reporting is property tax. And property taxes are, there's something, property is presumed taxable unless it meets some sort of state or local exemption. And the requirements here apply with a local assessor, and an exemption remains in place unless there's a change in facts. And then kind of last note on here is that a single piece of property may be both taxable and exempt. So you can have a building or another piece of property that is being used for exempt purpose and may not have the property tax assessed on it, and say another portion of that building be taxed. And sometimes, or kind of like a common list for property tax exemptions, we would normally see this apply for public schools or educational institutions. Hospitals can sometimes apply for these property tax exemptions, as well as churches, transitional housing facilities, nursing homes, just to name a few that may have that exemption. So unclaimed property. So again, a state and local issue, but unclaimed property occurs when one party holds property that's belonging to another. So an example of this would be wages that maybe an employee has not claimed or that have not been paid out. And after a period of inactivity, the property is returned either to the rightful owner or it ends up being remitted to the state. And so most states require the businesses to file these unclaimed property reports. And organizations should make sure that they are aware of their state reporting requirements in this area and make sure that those reports are being filed on a timely basis. So we do have a couple of unclaimed property examples here. And as I mentioned, wages, refunds, deposits, and then also checking and savings accounts and health savings accounts. So a lot of these items really do kind of deal with the employees of an organization. So always helpful to be aware that these requirements are out there. So kind of to wrap up this kind of other area of tax risk, you know, many states require nonprofit organizations to register and submit annual filings. And oftentimes, you know, these charitable solicitation laws and registration requirements, they are complex and they really do or can vary from state to state. So organizations should always be aware of and should check with their local state agency to determine the registration requirements for soliciting donations and whether or not a written disclosure statement or some other type of filing is required on an annual basis. And we've got a couple criteria here that could generate a potential registration, and that's soliciting funds, holding property, and doing business in the state. So really kind of following those old nexus laws. At least that's what I think about when I see those kind of 3 items there. But again, it's going to vary from state to state. So what might trigger a registration requirement in one state may or may not require that registration in another state. And it looks like we are on to question number 4. All right, Amy, if you'll pull that up. Many states require nonprofits to register and submit annual filings. True or false? And that is the correct answer. It's true. Most states do have, or many states do have that registration requirement. Let's see, and a couple last slides just on that charitable solicitation and registration, kind of covering what we already talked about a little bit. And these are examples of what the registration would require the organization to submit or report. And then, as it notes here, exemption may not be automatic. So sometimes that application for exemption must be submitted and approved with the state before the charitable solicitation is allowed. And one last slide here. This unified registration statement created by the National Association of State Charities and Officials and the National Association of Attorney Generals. And its overall goal is to standardize and simplify the compliance under the state solicitation laws, because as of right now, depending on what state you are soliciting in, the requirements vary greatly. So to wrap up, and as we're wrapping up today's presentation, I wanted just to take a few minutes to kind of reiterate how important it is to understand, you know, those potential tax risks facing exempt organizations, kind of by highlighting a few priorities that were identified by the IRS recently in the tax-exempt and government entities divisions, their fiscal year 2020 program letter. Now, this was actually issued recently. It came out on October 16th. And, you know, a couple of its focus areas really are the Tax Cuts and Jobs Act, as well as the Taxpayer First Act. Now, this is similar to the Treasury's 2019-2020 Priority Guidance Plan that I think I mentioned earlier, but both of them are really strongly pushing the Tax Cuts and Jobs Act and the Taxpayer First Act. So we're really expecting to see additional guidance come out on some of those rules. So as we mentioned, we're expecting that additional guidance on Section 512A6 that deals with the siloing. We're expecting to see additional guidance come out on 512A7 with respect to kind of those parking and those transportation fringe benefits, and the reporting on the Form 990T. And both of these plans kind of, one of the focuses of the Taxpayer First Act is to have entities move on to that e-file system. And, a lot of 990s, that's easy, we e-file it. But with respect to the 990T, those are still being paper filed. And, kind of some of the comments that we've seen from kind of that TEGE Exempt Organizations Council and what came out of those discussions is we might not see kind of the e-filing for the 990T until, say, the 2020 tax year, which would mean that people are not actually submitting it until 2021, or we might not see those e-filings come through or be set up by the IRS until 2022. So it's kind of a constant work in progress, but they want to get everybody onto that e-filing so that they can kind of, as I mentioned here, they pursue that non-compliance in the high-risk areas through their data collection and analysis and their technology tools. So when the IRS can have people e-filing and submitting their returns via the e-file, it allows them to have quicker data collection and analysis. It's easier and quicker for them when they have something that's electronically filed to be able to go through and find errors and also kind of collate the data and do quick comparisons for their examination purposes. I think one other item to note here about the program letter is it was split into 6 primary portfolio programs. And the first one was a compliance strategy analysis, and the second related to the data-driven approaches. And when we looked at the compliance strategies, really the specific areas that were highlighted by that TEGE program letter include some of the areas of tax risk that we've already talked about today. So I kind of put up here some of the primary areas that were listed, but these have specifically been identified by the IRS for this coming fiscal year as their top priorities. So this is where they see non-compliance, and this is where their focus is. So this letter, this program letter, called out unrelated business income as it's going on to the 990T. Private benefit and endowment, probably looking at this more from maybe a private foundation standpoint, but still falling under that C3 umbrella. Conversion of for-profit entities to 501c3s. Now that kind of goes back to our organized and operated for provisions that we talked about at the beginning of our presentation today. And making sure that if you have a for-profit entity and it transfers and fills out the application to become a C3, that they're organized and operated, or that they're not going to meet those tests to become tax exempt. Other areas included hospital organization compliance, and that's an entire kind of can of worms by itself. And then some notes, they did bring up the payroll reporting and backup withholding requirements, and we already know that that's been kind of an area of audit and examination focus. As the tax exempt and government entities division has brought on more employees, those people typically have expertise in that payroll area, and so that's been a big focus of theirs. And then a couple others on here, C7 entity investment in non-member, under and over reporting of charitable income by those non-exempt, and then tax exempt bond compliance as another area. Just a quick reminder for some of our upcoming Eide webinars as we close out our presentation. And you'll see that the next one, the year-end planning update, is actually this Friday, if you are interested. And we don't have too much time for questions, so we can either open up the lines, but as usual, I've managed to fill most of my time chatting today.
All is well. So there's just one that we are going to answer since
Okay,
there's
perfect.
no email attached, but it
Okay.
says, do all these rules apply to 501c 6s as well as 501c3s?
So kind of as I mentioned, most of these provisions, they do apply to 501c6 organizations, but the requirements might not be as kind of stringent. So, a 501c6, really should have that organized and operated for their exempt purpose. But in comparison to a C3, we wouldn't see quite those restrictions in, say, like the political and lobbying areas. So this presentation did focus on specific C3 items, and we can apply others like the UBI reporting that would apply directly to C6s, but some of the other areas might not be quite so strict because we did follow along exactly with the definition of a 501c3. And reach out to me if you have something a little bit more specific or one of the areas for the 501c6 that I can help to answer.
Awesome. Do you want to do one more?
Sure, we've got a minute.
Are there any updates regarding the parking fringe benefit in regards to UBI?
So that is another area where the IRS they're working on it. And so it's been highlighted both in the priority guidance plan and also in that TGE program letter, that those are the areas that they're going to be working on. And so we're expecting the guidance to be coming out soon for the parking, but we haven't seen it yet.
Okay. Sounds great. Thank you all so much for attending, and we do apologize for the audio issues, but we appreciate you staying on. So thank you to Christine, and we hope everyone has a great day.
Thank you so much, Amy, and thank you, everyone.